Good afternoon, everybody. It's Christian Thwaites at Brian Janikowski, and it's me and Carolyn O'Neill hosting the website, the webinar today. I hope everyone can see this screen. We'll go through a couple of slides here and sort of give you an update on the markets, trying to answer the question, is the market too expensive? That's on everyone's minds, has been for about the last 3 or 4 months. The short answer is no, but we'll go into a little bit more detail in a minute. There will come a time when I'm not talking to you at an all-time market high, which has been pretty much every month now since last April, May, where after the pretty calamitous correction we saw in April, May, we had a very swift bounce back for all the reasons we've gone over, and we've had a very strong start to the year. As I sort of sit here today, looking at just the year-to-date numbers, so barely 6 weeks in. We're at year-to-date, small caps up 16%, mid caps up about 8%, and the S&P is up about 4.5%. Obviously, over the last 12 months, 9 months, it's been even higher than that. But let's just jump in. There'll be a chance for questions. I think there should be a chat box up there where you can enter the questions along the way or keep them till the end. Look forward to answering them. Okay, let's just kind of review where we are. After December was a little worrying in the fourth quarter, just because we had that third wave come through, really hitting after September, October, and into November, and then some close downs in December, if you remember, including California. But things have started to come back a little bit. The economy, needless to say, is way below its capacity. I've talked about this in the blog, but roughly nominal GDP was about 21, just under 22 trillion last February, and now it's in the high 20s. So we've lost about $700–800 billion in output. In real GDP terms, it's a lower number because that obviously is adjusted for inflation. But I think we've lost about 5% of GDP, which at the pre-COVID growth rates would take us at least a couple of years to make back up again. So think of this as a V-shaped recovery, but with the V taking rather a lot of space up at the bottom. We had seen a manufacturing rebound pretty quickly. Part of that was trade related. Some of that was just because the manufacturing industry, although it's only 20% of the economy, actually a little bit less, is easier to get a handle on, easier to have numbers on than service industry. But we did see quite a good snapback after the big corrections over the summer. Now services are starting to come back up, and this is a theme which I'll touch on a couple of times today. There's huge pent-up demand for services, whether it's the leisure and entertainment industries or airlines or any other parts of the service economy. There's a huge amount of pent-up demand because this has been the part of the market, part of the economy which has been closed or certainly operating way below capacity during the COVID period. That's going out. But everything really depends on the vaccine rates. The vaccine rates are rising. I'll show a number in a minute, which just shows that it sort of seems to be back on trend. I think the Fed, and this is important, will continue to ignore inflation for now. They've made it very clear that they've got new measures in place for inflation. The roughly 4.1% unemployment, 2% inflation, which they have categorically explained many times, doesn't mean that it hits 2% once and they start to tighten. It's got to be 2% over a prolonged period. Obviously, they don't exactly tell you what that prolonged period is, but I think it's longer than 6 months, probably less than 3 years, some between those two numbers, depending on a lot of other things going on as well. The Fed is very pragmatic these days, I think, with Powell and the people that are there. They're not going to rush to doing anything quickly, and a lot of them remember the taper tantrum of 2013, where there was the hint that the tapering, i.e., the reduction of the purchases of treasuries and mortgages, would be quite dramatic. Set the market into a spin. So they don't really want to miscommunicate any of that stuff. On the congressional side, with the 1.9 stimulus, the chances are it's going to be less than that 1.9. The latest news looks like it's coming in by reconciliation rather than by the 2/3 budget changes. not terribly surprising, but I think whatever the stimulus is, it will help a lot. And these direct payments to people, sure, maybe some of them don't end up in the right places, but they're a lot quicker than fiscal stimulus. Now, ideally, you'd want both, where you've got a little bit more government spending to, on the evergreen subject of things like infrastructure. But for now, I think having people's unemployment benefits extended, some sort of loan forgiveness to small companies, state and local aid will help a lot, because state governments have had to reduce employment quite a bit, and they'll have to do it even more if they don't get some aid. But those things plus the actual stimulus checks do help, and it'll help quite a bit. I think the economic stats will continue to all be better this year. We've had a little bit of a setback with the non-farm payrolls, but other things are certainly pointing to a better progression. I think by Q2 we should be firing on all cylinders, providing, of course, number first point, the vaccine rates continue to be implemented. Very important thing to talk about this huge pent-up demand. There is a lot of it, and savings are incredibly high, and I'll show another graph on that. A lot of people have remained in work, haven't had a chance to spend as much as they would like, and just think of your own personal circumstances. What trips have you not taken? What airlines have you not bought tickets for? What restaurants have you not gone to? What all other things have you postponed? There's only so much that Amazon Prime and upgrading your hardware can replace those types of business activities, given that the US is about a 75% service economy. So savings are very high. I think they'll rebound very quickly. The risk assets, as I've said at the opening, are on a good run. They are supported by earnings. We've had a pretty good earnings season. It's not quite over yet, but so far the numbers have been better than expected. I think there was seeing about an 8% growth in earnings quarter over quarter. That's higher than most people thought. And there's always a high number of companies that beat their estimates, just because of the way the Wall Street game is played. But it's even higher this quarter with about 85%. So those are definitely pretty good, and we saw some very good numbers the last week or two from the big tech guys, and it's also filtering down to other industries and smaller companies. Just there we go. Sorry, sped too much. The cases are falling sharply, which is great. These are the top line. Borrowed this from Pantheon Economics, whose service that we use. But then there's the number of confirmed cases on a 7-day average, coming down by quite a bit. So we're 240,000 a couple of weeks ago, so into early January. That was obviously a bit worrying, and now we're about half that. So that's definitely moving in the right direction. This next one, there's the ramp up in the vaccine rates from early January. That dip there in the sort of last couple of weeks is mostly weather related, because they've been hammered on the East Coast with a lot of winter storms. And that really does affect people's ability to get out of the house, make an appointment, especially if some of these appointments are, in football stadiums and places which are difficult to get to. So expect those to start increasing, and then we've got on the right-hand side the number of potential people who've had at least one shot. Expect that number to get to the critical 20-30% within a couple of months. This is where we were a month ago. So when we met a month ago, I was pointing to these rather depressing numbers with the US in the full. This is January the 12th here, and in the full blast of the third wave, and there were upticks in Europe and Italy, France, and Germany. Now look where we are. Really much better. We've rolled over completely. So this is 7-day rolling average per 100,000. So it measures, it's all population adjusted here, but it was 70 of the United States, and now it's about 35. Similar decline, not they weren't as high to begin with, but European Union was about 35 and now down to about 25. So these are definitely moving in the right in the right direction. And in even some of these states, this is where we were, a month ago. All these states were seeing upticks from, again, the kind of the third wave taking effect and coming out of the vacation holiday period. And now look where we are. Things have come down. And some state like Wisconsin, which is just really suffering badly in November, is now probably, it's from about 120 down to 20. So that's a massive improvement. And all this is, as you'd expect, social distancing happening, close downs happening, some more rigorous than others. The vaccination rate has certainly helped. Yeah, and so there's just kind of less virility to COVID-19. So this is all kind of stepping in the right direction, and of course, this is what the market wanted to see. It's what it has seen. So it's all kind of very much come into picture at the same time. Now, let's just flipping over to the capital markets. This is the 10-year. This is the Treasury curve. So focus. Don't worry about this top one, which is a year ago. Kind of where we are now, which is this yellow-green. So I'm a little bit colorblind, so whatever it is, but the lighter one, not the red one. Here's the red one from a month ago. You've seen that we've slightly drifted up, except that this bottom end, which I don't know if my cursor's showing up, but that doesn't move very much. I don't expect it to move very much because the short-term rates are very much anchored by the Federal Reserve, keeping the Fed funds rate at about 12 basis points. Actually zero, but from an effective rate, it's about 12 basis points. So very difficult for this part of the market to move while it's so firmly anchored there. Once you get further out on the curve, these are more market-driven rates. So the 5 and 10 year, yes, they have QE going on behind them, and certainly the Fed buying plenty of treasuries right across the curve. But these are much more market-driven prices. So what we've seen in the last month is a slow drift up in the 10 year, gone from about, it's difficult to see, I know, but from about 100 basis points to about 115 today. It had got as high as 120. And then the 30 year, which is very sensitive to inflation, going up a little bit. But there's plenty of talk right now about the 30-year Treasury being the highest it's been since last March, and perhaps indication of inflation expectations. I would not give those a lot of credence. I mean, if it's the highest since last March, great. I mean, last March was just about the nadir of the deflationary experience from COVID. So yeah, I'm glad that they're up from a year ago. But this movement isn't really a big deal. I don't think it's there's perhaps a little bit more bearish tinge to the long end of the Treasury market, but in the bigger scheme of thing, with a 30-year Treasury drifting up by 15 basis points or so, I'd be like, so what? It's there's plenty of room there yet. We're not seeing a big bear market in bonds, despite a lot of commentary to the contrary. This is again, I can't emphasize enough just how important last August's redefinition of the goals by the Fed was, where they said essentially they're looking at unemployment about 4.1%. That's what they talked about as being the level of unemployment below which it starts to trigger some sort of inflation. I don't know whether, inflation's been such a non-existent part of our life now for 20, 30 years, in the sense that it hasn't been rampant or anything out of control. But anyway, they put that unemployment number before they never actually put a number to it. Now they have, and inflation at 2%, and you just kind of look back and how many times have those two things happened? 4 times. And right now we're sort of slight uptick inflation to 1.3%. 1.3% isn't nearly close to what the Fed wants to see on inflation. So, and the unemployment number is officially at 6.3. It's actually probably a little bit higher than that, quite a bit higher than that, just because of the way the employment statistics work right now. They're having a hard time keeping up with all the COVID dislocations. But anyway, these, you can see that until these numbers start to converge with each other, the Fed's probably going to be on hold. Now, there has been quite a lot of talk about inflation recently. It's showing up in some of these precious metal commodity prices. I noticed the cotton was at some recent high today. Again, I wouldn't put too much credence in this. I mean, silver is, so yeah, it's up 70% since the last couple of 2019, that's 2 years, right? Um, but it spiked up. It's probably too low here. Silver, a lot of ETF buying, and I think these Robinhood guys focused on silver as well. And if you kind of, silver is supply and demand are hugely in pretty much equilibrium. It's an industrial stock, I think much more than it is a precious metal stock. But there are people who disagree with that point of view. But you can see that silver's had a rocketing up. Now it's kind of flattened out over the last few weeks, but this is what people are thinking of when they're talking about inflationary times. So gold's had an uptick. These are all indexed from about 100 to about 100 and, 140. But really, the U.S. dollar has been weak, and the weaker it is, the more inflation is likely to come through. But this is pretty small, I think. And yeah, I mean, we can look to other commodity prices. Oil too would show up here as in a percentage increase, just because remember last year we touched about $20 and we're up to about 56 now. But I don't think these are really precursors to inflation. I've read recent stuff about this being a commodity bull cycle. I just don't buy it. I think some of this is, particular to these kind of markets that are going on. Some of the investors are putting their attention towards commodities. They're easier to trade now than they used to be, but it's difficult to see that hard precious metals commodities here or industrial metals like copper and so on are going to have a big run given where the state of the economy is. I understand that some of these are in short supply and you get a short-term squeeze on these prices, but as an indication for the next level of higher inflation, I don't think that's likely. And also, I think you'd see a big increase in wages. Now, I mentioned this in the blog, so forgive me if you've kind of absorbed all this already. But this top line number, this black number, is what the average hourly earnings are increasing at on a yearly basis. So most people look at that and go, "Wow, they're up over 5% year over year." But as I mentioned, all that is because the lower quartile of wage earners, the average weekly wage is about it's $1,100, something like that. But in the leisure and entertainment business, it's about $400. And those guys dropped out of the labor market big time. Obviously they were hardest hit. Although there's a part-time, I grant you, but nevertheless, a lot of these lower paid jobs just literally, were told to leave and go home and not come back. And so all that happened was the remaining workers just increased the average. But believe me, no one's really got a 5.5% average hourly wage increase over the last year. It's just the people who earn a lot less dropped out of the pool. This is much more likely to be the number. This is, instead of hourly earnings, which can be distorted by a number of different things, this is actually the employment costs. These only come out quarterly, whereas hourly earnings come out every month. But I think this is much more indicative of what's really going on. So this 2.6 is what employers are actually seeing. They're actually paying about 2.6% more, and benefits around about 2.3%. So unless you've got a big increase in that, then I wouldn't worry too much about inflation. You can see that these are even way below what they were in 06, 07, when there wasn't much inflation there either. So yes, we've seen it on the commodities side. We've actually also seen it in the 10-year Treasury inflation protected securities, the TIPS break even, so-called, which has risen upwards quite a bit. A lot of people pointing that towards inflationary fears. I grant that there's some inflationary fears, but I don't think that there's going to be long-lasting inflation coming through to the economy, at least not under the current circumstances. The budget deficit obviously getting a little bit more attention. Sometimes people just say it doesn't really matter. The Republicans seem to have, rediscovered their fiscal rectitude over the last few weeks, but obviously the budget deficit started to increase big time in 18 and 19. It had nothing to do with the economy. The economy was fairly strong at that time. It was all to do with the corporate tax rate cuts, and the various other personal income tax cuts. So that was just, the expenditure wasn't running high. It was just a revenue issue, which was passed as the 2017 tax gain, which absolutely provided no stimulus to the economy at all. It just if it did anything, it just brought growth forward by a couple of quarters. There isn't a particularly profound or original thought. Everyone said that at the time, but this started to tumble around about the time of the corporate Trump tax cuts. Then obviously now it's being hit hard time because we've lost 22 million jobs and we've got less tax revenue and more government expenditure, certainly on the benefit side. Now, again, I don't think these look scary, but last time I put up a chart which showed the average interest rate on government debt is about as low as it's ever been. Obviously, the government can borrow at 10 years for about 1.05%. It can borrow, for 2 years, I don't know, something like 40 basis points, something like that, and 10 years at 1.9. So, in real terms, these are all negative rates. So, I don't think it's going to be an issue where the budget deficit and interest payments as a proportion of GDP or interest payments as a percentage of government expenditure are going to increase to any alarming levels, which they last did about 30 years ago. So I think any talk about budget deficits is probably overblown. We are seeing slightly better numbers on weekly claims. Now I got a little bit worried there because from about October through till just the last week or so, they'd kind of leveled out with an occasional blip up. This is a log chart. It's difficult to read, but it has to take. This is about 220,000. As I mentioned before, the largest number it had ever been was in 1 month in 1981 and 1 month in 2008, where it hit 600,000. So this 6.8 million was just totally off the charts in a literal sense. I mean, the y-axis is very skewy on this chart to try and make it all fit in. So we had a nice progression down, and then by October we were at 800,000. That was a good improvement. Then it kind of bumped along the bottom here, and then it had just second and third wave began to hit, and we saw probably some higher numbers as a result of post Thanksgiving and then post Christmas holidays, New Year holidays, employment changes. The last week or so, it's been in kind of where we want to see it. Now, these are difficult numbers to come by, and they're very affected by how many people sign on for the pandemic, the PEUC, pandemic employment. It's essentially a supplemental payment to people's unemployment benefits, and they expired at the end of December. Now they've come back on again, and we think some of this increase in claims here is due to that. So yeah, hopefully we'll start to see these types of numbers, 700,000. So gradual improvement, and once the lockdowns and the closures ease up, they should fall by a lot. It's difficult to put an estimate on this, but if I was asked to, I think we should be down to 200,000 or 300,000, by the end of the year. These are the payroll numbers. Last Fridays were a little disappointing. I mentioned that in the blog. The unemployment rate came down, but a lot of this is due to the fact that more and more people are exiting the workforce, which is not a good sign. We lost 22 million jobs. If you add up all these increases in non-farm payroll here, which were as high as 6 million in 1 month, but you add all these up and you get to about 12 million. So there's still about 8 to 9 million, and then 4 million people just came out of the workforce, just exited from the workforce. There's another 4 or 5 million which are not accounted for. Don't know where they are. So this unemployment number, the real effective employment number is closer to this, 11.7%, which is certainly not in line with any kind of inflationary scares, and there's still a lot of work to do on the payroll side. But I think these will start to get better in the next month or two. And the Fed was the bond market was very non-reactive to this. The bond market should have rallied a lot with the negative print for December published in January, and actually probably rallied given this 49,000 number, which was for January print published last Friday. But I think the general feeling is that these will start to increase quite a bit over the next month or two, couple of months. I'm going to skip over that one. It's just the GDP numbers, which are pretty scary. I'll stick on this one briefly. So The last quarter was about 4%, pretty much in line with expectations. Obviously, we had -4, this massive -31, and then the 33. Now, I won't go through the maths again, but this decline is not offset by this increase, just because you need a magnitude greater than the decline to just get back to break even. And we're not at break even. The latest numbers from the Atlanta Fed Now guys, this is why this number is sort of over here for today, whereas we only have we've only just got the fourth quarter, 2020 numbers in just 10 days ago. But you can see that right now they're estimating about 4.6%. They tend to start high, and then you can kind of look back here. They tend to sort of get it pretty close towards the end of the quarter. So I'd say for now, this kind of 4% outlook growth for Q1 is in line with expectations. It's sort of very much a good sign here. This is the big one. I've shown it a couple of times here, but it's just look at the lighter line, the non-blue one. The other one's just in trillions of dollars, billions of dollars. Difficult to get your hands around it, but it's $11.3 billion of savings. Now that number is usually about 40. You can see it's steadily increased here as people got scared after the 08 recession. Back here, people didn't really hold much cash at all. But now it's about 52% of GDP. So that's not going to stay up there. That's going to be spent. And if it comes down to pre-COVID levels, that's an awfully large amount of savings which can be channeled towards consumption expenditures, which I fully expect them to do so. In other words, the snapback when it comes is going to be pretty strong. And I just kind of have to remind myself that this is a recession like no other. It's not been caused by, it wasn't caused by increased interest rates. It wasn't caused by banks having a meltdown and a lot of bad loans. It wasn't caused by a financial institution having a hard time and having to be bailed out. It wasn't caused by households over leveraging and getting into trouble or other kind of credit problems. Corporate balance sheets, personal balance sheets generally are in very good shape. So with all of those, there's no kind of damage to be repaired like there was in 08 and 09, where arguably even today the banks are still suffering an overhang from the excesses from that period. So that, I think, is one indication why this recovery is going to be pretty swift when it comes. Once people kind of feel that they've got that confidence, they'll start to spend because there isn't a lot of damaged capacity in the economy, which is a good, very good sign. I've also mentioned that autos have come back pretty much to the pre-COVID levels. They're about 16.5 million. You can show this chart again because it's pretty much the same story. And then new home sales, rocketed very, very quickly, after getting hit hard in the first couple of months, and then people started to buy new home sales. It's also the same for existing home sales and also for housing starts. It's going to run into a little bit of a problem right now, just because there's a capacity, probably not as many homes as there are people who want to move, and the ratio here of population to new home sales is still pretty tight. It's very tight up here, but it's still higher than it was in the 90s. So we will continue to see, I think, pretty good numbers on housing, but I think the incredibly strong numbers that we've seen in the last few months will begin to level off again. Won't see the same level of increases, but it's certainly a part of the economy which has held up very well. And as you'd expect, the demographics are changing. You've probably heard lots of stories about people moving to bigger homes if they're going to work from home more, and with mortgage rates, around the 2 level, that makes the cost of purchasing a house very cheap, and actually in real terms negative. So you can buy at negative rates, you can borrow at negative rates against an asset which is increasing at about 6 or 7%. So if you can swing it, it makes a lot of sense to buy, go and buy a mortgage, which is exactly what people have done. Let's just have a look at the this one I show, which is the quick version here is that over here the dividends on the S&P increased a little bit. They're up about $1 from where they were when we met a month ago. That's quite a lot, for it is still in a recession, and the S&P 500 companies, the ones that pay a dividend, essentially saying, yeah, we feel that with the cash that we've got and the outlook, we're okay keeping the dividend up, and in some cases increasing it. So that's been, it's still not back to its pre-recession highs, but it's getting there, and so that's a good indication. And the earnings, again, they're up by about $1 from last quarter. Again, way off their pre-COVID highs, except from 145 to 120, and now recovering up. At least shows that the corporate sector is slowly regaining its earnings growth. This is the rolling 1, 3, 5, 10, and 20-year numbers, and worth kind of looking at. So over the last year, the S&P is up about 18%. This is including dividends reinvested. And over the 5 years, about 18, and over the 3 years, about 17%. These are good numbers. The 10-year numbers are a little bit less than that, 13, and the 20-year number still has the 08, 09 correction sitting in there. So that's more like 7%. Obviously, I don't think these types of numbers are going to continue at those levels. I mean, it could, I suppose, but you'd need an incredibly successful corporate sector to essentially show returns which are probably 5 or 6 times the level of change improvement in the nominal GDP. So this has obviously been a tremendously good run. This is probably more like what our long-term expectations are for equities. 7.5 might be a little bit lower than that. And this has got, as I said, two big recessions in there. But it's, this is a good time to have been in equities over these kind of periods, 1, 3, 5, and 10, and even 20, where there was much talk of a lost decade in the 08, 09 period. But so it's been certainly a good run. This is what everything that happened in 2020. It's exactly the same slide I showed last time, but in 2020 we talked a lot about the top 5. They went up 43% for the top 5 companies in calendar 2020, and that meant that the mega caps, the top 5, that's Microsoft, Amazon, Google, Facebook. Who am I missing? Well, it doesn't matter for now, but the top 5 are huge beneficiaries of the lockdown, very much tech related, and had tremendous growth. And that meant that the mega cap 100 stocks was up, did very well as well. The rest of the S&P was just not that great. This is the large cap S&P up about 4%. This was in 2020, so it's very much a large cap story. Now that has changed a lot. This is the last 3 months, and now I've seen small cap since November the 9th up 32%, mid cap up about 20%. Emerging markets up 16, and then lagging at the bottom is the S&P up 10%, and the top 5 up about the same sort of number. So, yeah, there's been quite a reversal here. The small cap story is really about the market and the economy broadening out. The more stimulus there is, the more things open up, the more that benefits the small cap universe. These aren't necessarily cheap stocks, but they have a lot less defensive position than the large cap and the top 5 for sure, and the mega cap. So they tend to have more cyclical types of businesses. There's a fair amount of financials in the small cap index, also some energy stocks which have done pretty well. But also, I mean, I look at the industrials and the tech stocks in the small cap area, and they've all shown a pretty big change in earnings expectations, and that's been reflected in the experience for small caps. So for a long time, small caps didn't do particularly well. They did well in 1 year, and then they tended to outperform for the next 2 years. That's been the pattern pretty much since 2008. But over the last 6 to 9 months, they've been very much well worth holding in a portfolio with that kind of return. It's been nice to see. The valuations, sort of getting back to the answer to the question, we can measure by price earnings. Yes, it certainly looks high. You can dig deeper, and you can do the Case-Shiller, particularly adjusted price earnings ratio. That looks pretty high. Enterprise value to EBITDA. There's a ton of ways to do this. I mean, there's probably 100 metrics out there which you can adjust 6 ways to Sunday if you want. Most of them are going to show fairly large, fairly extended valuations, except for this, which is looks at the earnings yield, which kind of converts the earnings per share into an equivalent bond yield, and then takes that number less the 10-year treasury. So it kind of takes what the corporate earnings are earning in over and above what a 10-year risk-free rate treasury bond would do. And we're at about 3.3%, which is this is pretty much in line with this line here, and cheaper than it was back here. So really what this is saying is that bonds have very low yields, and the Fed has been instrumental in making that happen. But I think even if they tapered or talked about a rate increase, you wouldn't see the 10-year rate sort of suddenly go to 3-4%. It would probably stay, well under 2. In other words, I don't think the market is dislocated or distorted that much by the Fed buying at the longer end of the curve. And so if you get a low interest rate environment for bonds, essentially, equities look more and more attractive because you're getting something on the dividends, and you're sort of trading the uncertainty of equities for the certainty of bonds. And so this shows that really the earnings yield based on this metric is actually quite a reasonable level, and that kind of just coordinates with common sense here, and that equities are maybe expensive, but they're not expensive relative to other asset classes. Now, growth and value, I increasingly actually hear around down the increasingly sort of jaundiced by the whole growth versus value demarcation. It used to have some meaning. I think it has less meaning today. Essentially, you end up in the value index with a lot of banks, a lot of oil and gas stocks, and companies which are, essentially just really struggling to get, good returns. I don't think it necessarily represents value in the Warren Buffett sense, where you can kind of buy a stock that everyone else has neglected. You can buy it for a real bargain price and kind of watch it go to the moon. So that kind of value stock, I don't think it exists anymore. But we saw now this confusingly, the downslope means that value is underperforming growth. If you but it did quite well in the first couple of weeks of the year, where you can see, look at that value index. It just suddenly took off and left kind of growth. There's all this talk for about all of 3 weeks about well, value's coming back, and it's the sort of the unloved part of the market which is coming back into its own. Well, it just hasn't happened, and I'd have a tough time thinking it will happen, just because of the types of stocks which are in the value index. So for those of you that are clients know that we haven't been very big on value stocks per se, and we kind of continue to have that outlook. The other thing I would say is on this is look at this long-term chart. I mean, growth and value hasn't even been a contest. You're talking about $100 going from 100 to $1,500, $520 here versus $1,529 versus 803. So growth has outperformed value by exactly twice the amount. Now, value did well back here in the, in this 03, 04, 08 period, which, as we know now, was just banks leveraging up and going for growth. And the valuation metrics like price to book value looked cheap, but they were sort of driving themselves into the ground. So other than that, value has been a very, here they kind of tracked each other, but they started from a lower base. But anyway, you can see that it's very rare that only in this period really have we had any determined long-term outperformance of value over growth, and ever since then it's been downhill. And so yeah, one day that might change, but I don't think so under the current growth value type of demarcations. I think what ends up is that growth ends up being the successful companies and value ends up being the unsuccessful companies. And that's the kind of way the S&P gets split. I just have talk on some of these so-called meme stocks. So this, I mean, there were others, but essentially this was just the one that got all the press, GameStop. So, the background to this story that it's a retailer that sells mostly cartridges, game cartridges. And it was sort of known in the, I don't know, like 20 years ago. It was in malls and it would pay people minimum wage to sell the stuff. And that was the way people got their games. Obviously, that hasn't been the case for years. So it kind of kept going along, and then some activists got involved in it at about $4 a share. And they got some people on the board to sort of start pivoting towards more of a cloud distribution services, which you'd think would be a pretty obvious idea for a gaming, seeing as everyone else is doing it. But anyway, they took their time figuring this out, and then so the stock kind of rallied up to 10 on that, and then a lot of these short guys say, well, we don't think we're going to make it, so they started to short out the stock price, at $20 and so on and so on. And then you can see the volume here was like barely 10 million, and then it just went right off the charts here. It was I think it's 69 million shares, so you got 50 over. It's not even, it's higher than the axis here. So I think you're probably seeing 100% turnover of the company, every day, and that was all happening through not just the Robinhood accounts, but there are other people playing as well. The Robinhood guys just got a little bit more press than everybody else. Also, in the middle of it all, Robinhood had to stop restrict number of trades because they didn't have enough capital. I think the SEC kind of politely came up to them and said, you have to raise some capital here if you want to play with the big boys. And so they had to raise about $3.5 billion as a combination of taking out lines of credit and equity injection. So this inevitably this story has reversed itself as everyone expected. This was simply not sustainable at $500. I don't even know what the value of the company is. I don't follow it. I kind of struggle to see that it would be worth more than about $20 on a good day. So some of this might, still come down. But this is really, all this up and down was just a result of people buying in a pretty thin market, and then the shorts having to cover themselves. I explained it on the blog, but if you're short of stock, eventually you've got to buy it. And if the stock goes against you, you've got to buy it really quick to cover your shorts and deliver the stock back to the guy you lend it to. So all that was happening in a very short space of time. And this is kind of sad because this is the February 21st. So it's got another week to run. But a few weeks ago, people were paying over here $200 for the privilege of buying GME at a price of $530. As so, obviously they expected to go from, it was about $500 briefly for a couple of weeks ago. They expected to go to $600-700 before they're going to be in the money. So those options, if you're still holding them, went from about $200 to 17 cents, and that's an example of leverage getting wiped out. So when you put an option, you can lose everything. Some of these contracts probably weren't very big, but nevertheless, it has no residual value once the stock price comes way below the strike price. And you can see here when these flat lines when the stock got closed. So it didn't mean that these things traded at any time. This is when the stock exchanges put these no trade rules in force if the stock had fallen or dropped by, I can't remember what the rule is anymore, but 5% within half an hour or something like that. But anyway, so if you were holding at this time watching it go south, you couldn't do anything. All these periods of when things were actually closed. So yeah, it's kind of sad to see, but there are other stocks which another one was AMC. There's two AMCs. One is the sort of cable TV content provider, which is a good company. Another one is the other AMC is American Movie Corporation, I think it's called, and it basically owns theaters and cinemas, which are obviously in very, very tough shape. People confuse the two, and were piling into the wrong AMC. So that's happened before too. I don't view this as anything like a kind of end of cycle blowout. I don't view it as the retail investors getting involved and getting scorched by the pros. It's or being as a contrary indicator. I think it's a combination of retail investing being so easy to do. The apps nowadays are very easy to trade on, and can misleadingly slow because they can really forget to tell you about margin calls and things like that. But anyway, it's easy to do, and I think there's a lot. There's much better platforms now, like the Reddit platforms, for people able to swap information and ideas. So I would view this as just as something which is going on because it can. And I think what will happen is that what's already happened, Robinhood has sort of been got the call from the regulators and told to back off a little bit and make it a little bit harder to trade in some of these more liquid stocks. But yeah, it's sad to see when people buy something at 200 and a few weeks later it's worth 20 cents. But I think it's more of it's not really an indication of excess. There are pockets of excess in the market. Sure, Bitcoin, um, the SPACs and some of the IPOs, but I don't think it's cascading over into the market being overly blown out and having ridiculous excess valuations in it. Okay, so just kind of summing up here, the markets right now are expecting some sort of fiscal stimulus. They're going to get it. Probably won't be the 1.9 trillion. Vaccinations increasing and improving. They're going to get that too. It might, there'll be some short-term hiccups where it's not as strong as people would want, but we'll get it. And they're expecting the Fed to stay on course, which they're going to get that as well. So that all kind of equals very strong growth, I think, from Q2 2021. If we get all those, especially the first two and the vaccinations working, we'll see this big pent-up demand come roaring back, I think, on the consumer side, particularly in Q2. If the current, I'm badly phrased here, but I'm talking about here the fiscal side. If it's going to be something less than 1.9 trillion, doesn't look like the minimum wage thing's going to go through. But if they do need to come back in the summer, they will. I don't think they will, but now if there's a consensus, remember Janet Yellen said go big, and she's very well respected in Treasury and in government generally, and of course she's got the history with the Fed. So as long as that kind of competency is running the Treasury Department and directing the current administration's economic growth plans, I think they will do what needs to be done here. She's a labor economist, don't forget. She is very cognizant of hysteresis, which is when the labor market sort of goes, can't get jobs anymore and stays out of work for so long that they become unemployable. So she's very tuned into that. She doesn't want to see a large cohort of the workforce essentially not come rushing back to full employment. So she'll direct a lot of this. As I said, the consumer revival will be very strong. The corporate sector is upbeat. We've been tracking the earnings, the results. Yeah, there's a lot of companies are going to report relatively good results compared to what their estimates were. Margins will be quite strong because they'll be able to keep a lot of price gains in there. We've seen that in various different surveys where prices are holding firm, and a lot of companies have reduced costs. You could think of a lot of companies right now, which service companies, which are not traveling. They might have had huge travel budgets or huge rent budgets, and those are almost non-existent on the first one and a lot lower on the second one. So that means that margins, a lot of service industries will be looking to improve. And corporate earnings, I haven't changed this from a month ago, but I think we're going to see a 30% rise in corporate earnings. I think I showed that earlier. So our record is about $140 earnings per share on the S&P. So we're about 120 now, but I think that's going to increase quite a bit over the course of the year, and we'll also see dividends increase. Okay, I'm going to stop sharing there just because I think we might have some questions. Let's see if I can get to those. So Karen, I think you can't see the questions, but let me just see.
Actually, I was able to get the questions back. It looks like we have one, if you can see it there.
I can, yes.
Okay, great.
If you had a significant amount of cash right now to invest and a 10-year time horizon, would you invest it all at once or dollar cost average into the market? I think if I had a 10-year time horizon and you really had the discipline to stick to that, I'd probably be more inclined to put it into the market right now. But in reality, a lot of people do that, and if you get a 20% correction, they're going to kick themselves a lot. So I'm going to hedge the bets and say it really depends on your level of confidence and how likely you are to to change your mind based on the a potential correction in the market. But I think without question, a 10-year investment, well, no, not without question, but I mean, I certainly feel very confident that 10-year investment into equities will pay off very well. Maybe in the region of 7 or 8%, which is 3 times inflation and about 3 times earnings growth. And I think we'll have it's very rare that a 10-year return in the market goes negative, and so I would be pretty confident about that. Any other chat? No, I think we're good. So thank you very much. Any questions that you hadn't thought of here? Feel free to email me. Our email is pretty easy to find on our blog, or else call your financial advisor, or just call the main number, and we'll be happy to address it. Thanks very much. I'm now going to just read the disclosure. So for those of you that want to stay, that's fine. Otherwise, we'll look forward to catching up with you next month. Discussion of the investment strategy, research, investment process, Brown, Young, and Kowski are of the date indicated or as of the day of this presentation, subject to change without notice. Charts illustrated through this presentation may be updated periodically. We have no obligation to provide revised assessments in the event of changed circumstances. We can assure that the types of investment mentioned in this presentation produce the intended results or outperform any other investments in the future. We reserve the right to change our investment perspective and outlook without notice. Market conditions dictate. As additional information becomes available, diversification does not protect an investor from market risk, does not ensure profit. The information subject to unintentional errors, submission changes without notice. All sources are from FactSet, unless otherwise noticed. While we gather this information from sources we believe to be reliable, we cannot guarantee the accuracy or completeness of any statements or numerical data in the presentation. References to an individual security should not be considered as a recommendation to buy or sell that security. The securities noted in this presentation are only several successful but unsuccessful investments where Brown, Young, and Kowski do not represent all the securities we have purchased or the recommended. Index returns include reinvested dividends, interest, but do not reflect commissions or transaction costs. Mutual fund returns include reinvestment dividends, capital gains distributions. Mutual funds returns on all of the funds. No other funds expenses, however, they do not reflect Brown, Young, and Kowski's fees. Please read the prospectus carefully before investing or sending money. Past performance, no guarantee of future results. We may reference various hypothetical investment illustrations used for illustration purposes only and not investment recommendations, and do not guarantee indication of future results.